the best part about build to sell, build to rent is that it's the same product. So you go into the deal, you're like, hey, we're going to build, sell this thing. Well, what if the market really takes a turn? The rental market itself isn't getting any smaller. So we can, by theory, be able to rent the property out, service our investor debt and our coupon, and hold it until the time comes where we can sell it again. Do we think that's the plan for everything? Not, absolutely not. But that is the plan when it comes to build to sell.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Kevin Dureiko is a husband, father, private debt fund manager, and also a capital raiser. Kevin, welcome to the show.
Thanks for having me, man.
Hey, man, the pleasure's mine. There are 3 questions I ask every guest who comes on the show. In 90 seconds or less, can you tell me, where did you start? Where are you now? And how did you get there?
Well, I started in 2007. I created the company to be a debt buying fund. Quickly realized that that is more of a game that I don't want to be into for many various reasons. We transitioned into the debt portion of real estate, and now our Q3 and 4 fund will be syndications, ground up construction, and obviously continuing to do real estate debt.
Right. So this is, obviously you gave me a 2007 to, that's a 15-year span that you just sent less than 30 seconds. That was pretty impressive, by the way.
Yeah.
Talk to me about how you created a company to buy debt. Like, I mean, just wake up one morning and have lightning struck my brain and here we go, we're going to buy debt. I mean, how did that work out?
I wish it would have been that easy, but no, just listening to the tales of my family and their history. My grandfather was a marshal, and in Connecticut, a marshal basically is a debt collector. Oh. And then basically, my father told me, you can basically buy judgments, buy debt, buy mortgages for less than what they are. And I was like, man, that's crazy. You can buy money for less than what it's worth.
Right.
And, as a kid, that was a concept you couldn't even comprehend. So I just went on this learning curve of, what you can do with this type of stuff. And it just basically led me here.
Wow. All right. But as you were into this, then you quickly figured out that, hey, you know what? Buying debt's one thing, but buying debt that's attached to real estate is probably a better spot to be. Was that the conclusion, or am I missing something there?
No, that was the conclusion. And then you figure that you can, the debt that you do put out or the debt that you do collect can be assigned to a real estate deal. It can have, multipliers. There's so many different ways you can turn that money into more money. It just is the natural course and natural set that we went with.
I got it. Was there a particular asset class you focused on, or you buying distressed debt? Or you buying, what types of debt were you guys focused on? Mostly
distressed debt. Buying out contractor related debt. Somebody goes and liens a house, we'll buy that lien out and then eventually collect it.
Interesting. Okay. Very, very cool. I know there's a lot to unpack there. Is that distressed debt the same? Is that the same model you're using today, or has that changed?
That's changed considerably, or almost not in that business whatsoever.
Okay, cool. But you said you guys are launching a debt fund here, or you have one launched right now. I guess, can you walk us through that fund and how that functions?
Sure. Yeah. We take accredited investor capital. We lend it out to real estate investors, the simplest form. So if you're a guy in syndications, we're coming in with the first debt. You're bringing your LP money. We're financing that portion of it. We're doing fix and flips, and up until recently, we're doing 30-year short-term rentals, long-term rentals. So this is not a conversation I've had with anyone on this show yet. You guys are bringing debt to syndications in the first position, like you guys are the bank. Is that what I'm hearing? You're hearing correct. Okay. Well, interesting. Tell me more about that. What are there asset classes you're focusing on? Where do you see opportunity? Why do you see opportunity there? Can you kind of give some more color to that? Multifamily syndication. That's where our main asset class is. We want to see value add. We want to see a little bit of experience, and we want to see an exit in a game plan. So you come to us with a deal for $5 million, you need to put 25% down or something along those lines. We'll pick up the rest. That's really, really intriguing. How are you guys making money on that? Are you guys, obviously you're collecting the interest on it, but are you flipping that debt? Are you holding it in-house? How are you guys monetizing those new debt positions? Balance sheet, we don't sell anything. The syndication model that we're running, especially with our fund, is that we want to have total control of the capital stack, and it allows us to give you as an investor more security, knowing that, if you have a problem, you can pick up the phone rather than me selling it to Wall Street and then you have to deal with all that.
What type of investor? I'm sorry to narrow in on this because this is just a unique. It's a unique thing that I think you're bringing to the market. Maybe it's unique, or maybe I'm just have my head in the sand. But I haven't met a lot of people that are out raising money for a fund that is they're raising money basically, to be the 100% lender, first position on a deal, and then holding it in house. I mean, one, that's a lot of capital to raise, right?
Correct.
And then two, there has to be a particular type of investor that is good with whatever the interest rates are that you guys are charging and then return you're getting on that capital. So what type of investor is typically coming to you guys and saying, hey man, I'd love to just come in and be debt only on a multifamily deal? I mean, there's some pretty competitive, loan terms out there from other sources. So tell me about the investor that is your kind of ideal investor.
My investor is somebody that doesn't want to tie the capital up for a long period of time, but they want to be able to be having a asset-backed way to secure their money. So the debt that we're putting on multifamily properties isn't the long debt. It isn't the Fannie and the Freddie and the government-backed debt. It's the restabilization debt. So the purchase, maybe a 1 or a 2 year hold, add some renovation budget into it, and then we're going to be taken out by sale or refinance.
Got it. Okay, cool. How have you guys changed the way you guys structure your loans, in the last 12 to 18 months?
We've structured it. It's a little bit more stringent when it comes to experience. The leverage is relatively the same. We're still looking in the 65 to 75% range. And that's all depending on obviously the property. No loan is cookie cutter, or no deal is cookie cutter, no borrower is cookie cutter. So it's a la carte. We figure out what the best scenario is for the property. We're not a loan to own lender. And that's a terrifying string of words if you really think about it. So, we're looking for the best portion of the deal. And the most part is getting your investor capital back to your investors, because everybody needs to be happy. We don't need a string of lawsuits. So, we're securing our capital with a great asset, a great income producing asset, for a particular type of investor that, wants to tie their money up for a shorter period of time other than a syndication itself. And we go about it that way.
Right. So your investor, again, just to recap, if I understand it, somebody says, hey, look, I'm good with maybe a lower return profile, but yet I know I'm first position debt, and, it's something where I don't want my money tied up for 5 to 7 years. This is great. I'll clip my coupon, and then hopefully we'll exit in a few years, and then, we can do something else with it, or, reinvest. Is that what I'm hearing?
That's basically it.
Cool, man. I like that. It's the reason I dig in on that is because I think myself in particular, maybe I'm speaking just for myself here, is that I get this idea that there's one particular type of investor, right? It's like I saw something the other day that was like hey, invest in this, and it was like a 5% return, and I'm like, that sounds. For me personally, I then color all of my investors' conversations through my own profile of what it is that I want, which is obviously not the right thing to do. But it's interesting just to hear out there that there are other investor profiles that are like, oh, you know what? I'm cool with just a coupon and a 3-year plan, and then we're back out, and then we do something else. So that's I think that's just a good encouragement to all of us to not silo our thinking around who our investors are.
Yeah, it's diversification, just like how our fund is mutating and changing out through the ways that we are right now. At one point I was only a debt fund. Now we're getting into the ground up. Build to rent, build to sell. And the best part about those types of assets, along with multifamily, is you can hold them. I can still pay a return regardless of the scenario that's happening. If we have to hold it longer, we hold it longer. If I could sell it, return all the investor capital, and everybody's happy, we can do that. So we're leaving ourselves different avenues for investor capital to come in. I do get to talk to a lot of people like yourself. I'm sure you talk to a lot of people on a daily basis. And their sentiment of what they expect out of the market is different nearly with every person. So, to give people options, whether it be a syndication, different type of LP, bucket, or what have you, we can structure something that generally is going to fit people.
Tell me about this. The 2020 changed a lot of investment theses. How has yours changed?
Absolutely changed the way we look at everything, honestly. You don't know what's going to happen anymore. We have a country invade another country, and next thing you know, our capital markets have basically dried up. on the secondary, you might not see it too much on the front end, but on the secondary market, I don't know if you've, seen in the last couple of weeks or last week rather, Sprout Mortgage just closed their doors. They're one of the largest QM mortgage originators in the country, and they just shut their doors. So it's 190 million of probably toxic assets that are going to hit the market the next couple of weeks. What's that going to do to the market? We don't know. So we've taken the ability to be able to change and be liquid. If the debt markets aren't going to, help us out providing just debt capital, but our investors still want a solid return, we'll start building some houses in markets that need either A, home value, home rent, home sale. You figure it out and you just keep on moving.
That's really cool. I like that. I mean, build to rent is something that, gosh, here in Memphis, it showed up maybe 7-8 years ago is when I first heard about it. And it was like, oh, that's interesting. I would have never really thought about that. And yet it seems to have kind of caught fire across the country. And I hate to say it, but we're becoming a nation of renters. It's just, it's the sad reality of it. But it's also, if we're becoming a nation of renters, then why don't we provide what the people want, which is rental houses? So it sounds like, that's where you guys have gone. Tell me, how have you scaled that? How have you, because that's a whole new operating business. How have you guys entered that market and done it in a way that doesn't just create a new job for you?
The partnerships you join and gather throughout the years. So it's not something you can just jump into. You have to know markets. You have to know how it works in certain areas of the country. Partnerships with the right people. So, I've met many people in the building space over the last half decade, and through conversations and what are you doing here? What are you doing there? And a lot of the best opportunities right now in build to rent are developers that still have land from the 2008 fallout. So you have people in the South that bought up big tracts of land that are sitting on these things with low inventory. They can just print houses with waiting lists.
That's crazy. If you'd asked me that question, I would have failed that were it true false. You had said, hey, there's, large tracts of land out there from the leftover from 2008 that still aren't developed. I'd have been like, no, false. Really not the case. No. How are you finding, how do you, that's a needle in a haystack. So it's either your partners know those people with those land, or you're finding that needle in the haystack. How's that working out?
A guy who knows a guy who knows a guy. And that's just usually how it ends up working in almost everything.
Isn't that a fact, man? Isn't that a fact? It's who you know. So tell me this. Give me the breakdown on build to rent versus build to sell, because I know you guys are kind of doing both. How are you deciding what you sell, what you build to rent? Is there a particular type and size that you guys are building? You're saying, hey, we're doing this in this market and this in that market because there's different wants and demands. Can you kind of give me the lay of the land on this, if it were about what you guys are seeing? Yeah.
So the best part about build to sell, build to rent is that it's the same product. So you go into the deal, you're like, hey, we're going to build, sell this thing. Well, what if the market really takes a turn? The rental market itself isn't getting any smaller. So we can, by theory, be able to rent the property out, service our investor debt and our coupon, and hold it until the time comes where we can sell it again. Do we think that's the plan for everything? Not, absolutely not. But that is the plan when it comes to build to sell. Will we do build to rent portfolios? Absolutely. But we're going to take the opportunity to give our investors their capital back and their return for anything else.
Right. Are you guys building whole neighborhoods? Are you doing one-off infill lots? How does that work?
Most of it is in Florida. We haven't broken ground on the build to sell, build to rent yet. We have a partnership that we're putting together in Florida. They have the land; it's already permitted, so it allows us to build. We're not doing big tracts of land because this developer has already put it together. It's already a community. He is just allowing us to get into the community as an investor, which he does not normally do. So we get to piggyback on what he's already accomplished in the area, already establishing his communities. He's a big builder. Not to say, he's got all over the South, he's got different developments and different dealings. So it's given us a unique opportunity to work in that market without having to move equipment, not having to do all the permitting. It's already there. He's just allowing us to come into it. And we're starting with three to five homes at a time in little chunks, because nobody has a crystal ball. We don't know what the markets are going to do. But, if we do them in 3, 4, 5 house chunks, it will serve us, the investor, and the builder. Everybody should win.
Are any of these houses going multi-generational? I've seen that in some of the build-to-rent space where they're doing, 4,000, 5,000 square foot house, multi-generational. Are you guys seeing any of that in the product you guys are putting out?
In the product that we're putting out, it's going to be the 1,700 to 2,300 square foot range. The perfect, not starter home. It's in a little bit more of an affluent area that we're, putting these properties up with a high demand for single family homes and rentals. So depending on which way the market goes will kind of dictate the size of the home, the build quality. We have a certain threshold that we have to, withhold, especially in the community. But it all comes down to, what do the people want? Before they were more on the 2,400 square foot range. Now they're trending down a little bit. And that's not because of anything else other than we want to make sure they're not sitting there waiting for a particular buyer. We want many buyers.
Right. You want to build a product that has the largest pool of buyers waiting for it. Absolutely. Let's shift gears a little bit here and let's talk about some maybe softer skills that you have developed over the years. When you think back on your journey from 2007 until now, what are some things you feel like you've done really well that other people should emulate?
Having an innate ability to look past problems. There's no such thing as a roadblock. It's just how do you get around it? I don't know what it is, what instilled it in me, but I just don't give up. I don't take no for an answer. I just keep on pushing, and it didn't matter what really was happening in the economy, what was happening with myself. I was going to figure out something because I'm not a 9-to-5 guy. Never have, never will be. There had to be something else, to this life, and putting together an action plan. I don't know what the ability was and where it came from, man. I wish I could tell you, wish I could bottle it, but that stick-to-itiveness, not making money for a long time, knowing that there's going to be something on the other end. I mean, that takes a special type of human, and I wish I could bottle it, give it to people.
That's awesome, man. I love that. What are some things when you say that? Are there some particular scenarios that come to mind where you're like, man, this was something where I feel like maybe other people probably would have given up or just, gotten run over? Yeah.
So let's see. A couple of years I was an engineer. I worked for an underground utility company. I live in Connecticut currently, not for long, but right now you shut down for half the year. You can't do utilities when the ground's frozen.
Right.
So, that was a cushy, 70, 80K a year, half of the year. One year I just woke up and said, I can't do this anymore. I can't sit here. So, walking away from that, people thought I was crazy, then moved on to that, basically jumped forward a little bit, met my soon to be wife. And I was like, okay, now I really got to figure this out. And, within a couple of years after that, I'm trying to retire her. And now she gets to stay home with my, one son and soon to be second daughter. And, it's just one of those things you just don't know how it's going to end up. And that goes to the stick-to-itiveness of just, not making any money on this side hustle, trying to figure out your life. And it just, like I said, 2007, now there's been some bumps, but steadfast. The company's been around and it just figured it out.
Right. Yeah. No, I love that. Yeah. Because there's a lot of people that do give up too early when they're probably right on the brink of success and they don't know it. So that's awesome.
What's that book, 3 Feet from Gold?
What's that now?
That book, 3 Feet from Gold, everybody turns around.
I've never read it, but there you go. There's our book recommendation for the day. 3 Feet from Gold. I'm going to write that one down. Tell me this, what's a mistake you've made that you feel like other people could avoid?
Selling assets. My father was a blue collar real estate investor. I wish I would have known what I know now and not have him sell the assets in retirement. Wish he could have just held on to everything. It was basically, he told me, hey, you can have this stuff if you really want it. I said, no, Dad, cash out, live out your retirement. I'll figure it out. And what I should have said was, well, let's put some lipstick on these things, get a little value out of them, and really set you up for retirement. That's what I should have done. But I just didn't know any better.
Didn't know any better, man. Isn't that a fact? And that's that's a lesson we share in common. Where you go, golly, like I look back on everything I've sold, and I go, I shouldn't have sold any of that. Well, maybe one or two that were dogs, but outside of that, it's like, why did I sell anything? That just didn't make any sense. Didn't make any sense. That's awesome, Kevin. Thank you for taking the time to share with us both what you've done well and the mistakes you've made. You've shared with us about your debt fund, how your thesis has changed and what you guys have invested in changed, and really brought to us a unique angle here on, being the debt side of multifamily syndication. I mean, that's really, really unique. You guys are raising a lot of capital so you guys can go out and be that first position debt. And then also the opportunities you guys see in the build to rent and build to sell market, certainly, or build to sell space, certainly appreciate that. Are there any other closing thoughts you have here before our listeners, before we sign off?
Just keep going. Don't stop. Get as much information you can. I mean, I've been doing this for a while. I still watch every podcast, read every book. It just, it never stop learning. And it'll serve you well. The best investment you can make is in yourself.
That's absolutely right. Kevin, if our listeners want to get in touch with you or learn more about you, what is the best way to do that?
You can find me, Google me, pretty hard name to miss out on. There's only one of me. Kevin Dureiko, Dureiko. Throw that into Google. And then you can find me on my website, birchanddobson.com, BIRCHDOBSON.com.
Awesome. Kevin, thank you again. Do appreciate your time.
Thanks, brother.